Great, we're on to chapter 17, the cash flow statement. And we're hoping to get through this in a couple of different videos, but let's get started. So, cash flow statement is one of the three standard financial statements: balance sheet, income statement, cash flow statements. They show up in most larger companies' financial statements. Big picture, what does it do? It just says, where did the cash come from and how did the company spend it? There are two different approaches, the direct and indirect approach. We are actually going to work with the indirect approach in our class. There is a direct approach and it's in the appendix, but you're not responsible for that. So what is a cash flow statement? Well, specifically what it is, again, it reports the cash flows, both receipts and payments during a period of time. Generally, that period is the same as the income statement. It shows where the cash came from, so sources of funds, and where it was spent, so you can call it uses of funds. In the bottom line, it basically tells you why the cash was increased or decreased, and again, it covers the same period as the income statement. Here's a cool little table about this, and just shows you how, if you look at this, the income statement is based on a period of time. In this case, it could be for the year ended December 31st, but the balance sheet is always based on a point in time. So it could be December 31st, 2019 or December 31st, 2020. But yeah, this is a much bigger period. This is just a point in time. Now, you can have all sorts of transactions that affect the cash account, all sorts of things that you know. How much cash you had to start with, what sort of money you got from your customers, on and on and on. There's all these cash receipts and cash payments, and you'll notice that what they do is they increase or decrease cash. Each one of them does that. Now, without cash, yeah, your company's not going to make it. Cash flow statements help to sort of predict what's going to happen in the future. It certainly needs to influence management decisions, and not only for operations, but also the ability of the company to pay dividends. And there's a distinct relationship between net income and cash flow. We're going to take a further look at that. Negative cash flow from operation, that happens, but it's really a challenge. If a company is operating and not making money at its operations, one would say, why are we operating? You can end up in bankruptcy, but if you have negative cash flow, you're going to be in trouble sooner or later, and yeah, things are not good. You also need to understand what makes up cash. Cash is a bank account. We often think of that, but it also is at other times other things, including short-term investments that you can convert to cash fairly easily. Things like money market funds or Government of Canada Treasury bills. So when we talk about cash, just know that it's more than just the bank account. It often includes these cash equivalents or things that you can very quickly turn into cash. Now, how's the cash flow statement set up? Well, there are three different ways of setting, or three different sections that you set up. When we look at that, the first one is called operating activities, and in the indirect method, and we'll key there, what we're doing is we're reconciling net income to the net cash provided by operating activities. In other words, we know what net income is, but if we adjust that to a cash basis, what sort of income was generated by operating activities? They both work the same whether you do direct or indirect. You still get the same number, but yeah, we are going to use the indirect method here for this. There are three different categories for business activities. Operating activities, that's the day-to-day stuff that we see. If you've got a clothing store, it's the buying and selling of product and employing staff and paying rent. Investing activities are different things. They are doing something outside of the normal sort of transactions, and you're actually investing in your business somehow. Financing activities have to do with how we gather up funds to run our business and how we repay some of those funds. So we've got a section for each one of those activities. Now, operating activities, again, they revolve around creating revenues, expenses, gains and losses. They really line up with the income statement very well. They also line up with the current assets and current liabilities on the balance sheet, because all of those items, generally speaking, are a function of the income statement. Accounts receivable, accounts payable, inventory, prepaids, they're all linked to the income statement. And so when we go to look at the indirect method, we look at those particular items as well when we're adjusting to make sure that we understand the cash. Investing activities, those are things like investing in property, plant, and equipment or other long-term assets, perhaps long-term loans to maybe a subsidiary of your company or a specific supplier or customer. But they're loans that the company gives to someone else. They're very important, possibly next most important to operating activities, but they're important for sure. Financing activities are how we finance our business. They're often related to the credit side or the balance sheet, liabilities and shareholders' equity section. Things like issuing shares and the money you get from that, paying dividends out, and even buying back shares for sure, or borrowing money. That's probably an even more popular one, is if you're borrowing money and then paying off the loans associated with that, then those are all financing activities. So here's an example of how we look at these things in terms of whether something is an operating, investing, or financing activity. Any sort of operating cash flows flow through usually current assets and current liabilities. If you're investing, you're usually talking about long-term assets, so the rest of the asset side of the balance sheet. And if you're talking about financing activities, you're generally speaking about long-term liabilities and owner's equity. So, and we just break it into cash receipts and cash payments in this case. Now, we do include in operating activities some little strange stuff because they show up in net income. Interest received and interest paid. So those are sort of key things. And dividends received, not dividends paid to shareholders. That's going to show up in financing activities. But dividends received show up under operating activities, and they get included in net income. Now, there are certain things where we have non-cash investments. We can have dividends that are reported basically as under financing because they don't show up in the computation of net income. We don't have those numbers there. It's separate and apart from the income statement. So cash has to be reflected in the cash flow statement if there's any cash. So if we're talking about cash dividends versus stock dividends, well, that's two different things. Stock dividends, there's no cash involved, so they don't show up on the cash flow statement. Now, understanding as well how much free cash flow you have is very important for the viability of a business. It's basically the cash provided by operating activities minus the payments for investments and other long-term assets. So what do we made from our operations? How much money have we made operating? And what have we had to pay out for the big things? Well, property, plant, and equipment, long-term loans, that sort of thing. All right, let's go on to our next objective in just a moment.